I watch founders trying to bluff AI, and they have 5 or 10 beautiful slides in their deck. And I'm like, do you have a shipping product, and do you have incredibly fast growing revenue? And if the answer is no and no, the slides don't matter.
Dave wrote a great opinion piece about the era of haves and have-nots in the era of AI, and it sparked a great debate that we're going to be diving into today.
If they're asking you to 996 it, 996 it, because you want that brand on your resume. It doesn't actually matter if it's true. What they all believe is that these discontinuities create the opportunity to reset the order. Felt like a pitcher at a Major League Baseball game where I deliberately hit the batter with a ball and like both pitches cleared, everybody ran on the field, there was like a giant brawl.
Hey everybody, it's Sam Jacobs. Welcome to Top Line. We've got Asad Zaman, my beautiful co-host and the CEO of Sales Talent Agency, and we've also got Dave Kellogg on the show. Dave wrote a great opinion piece in the Top Line newsletter recently, really about the era of haves and have-nots in the world of AI, in the era of AI, and it sparked a great debate that we're going to be diving into today. Asad, why don't you set it up for us?
So, as our listeners know, the newsletter has evolved into a publication. We have great experts like Dave who have agreed to write editorials for us. And Dave's was the launch of the publication, and the era of haves and have-nots was the editorial. And so we're going to spend some time talking about this, the thesis, the takeaways, the reaction. I'm not going to try to frame the entire editorial, but what I'm going to do is I'm going to read out the first paragraph because it frames what we are going to talk about, and then I'm going to hand it off to Dave. So the paragraph is this, and I think it's beautifully written. AI has created an era of haves and have-nots. AI native companies with spectacular growth rates are grabbing all the attention, talent, and money. Is this insanity? How long will it last? And if you're not among the ranks of the AI native high flyers, how do you avoid becoming seen as a zombie, a living dead SaaS company with uninteresting growth, little profit, and no future? Dave, tell us a little bit about the thoughts you shared in this and the reaction.
Sure. So the reaction, I felt like a pitcher at a Major League Baseball game where I deliberately hit the batter with a ball and like both pitches cleared, everybody ran on the field, there was like a giant brawl after. So I think it didn't spark. One of the things I thought was so interesting is I don't think it sparked one debate. I think it sparked like 5 debates because everybody had a different thing they didn't like. Some people are like, I can't believe you're telling us to work 996. It's like, well, I'm not. And others are saying, what was another popular one? Another one was about the whole notion of haves and have-nots. There's a separate thread on winning because I kept saying, hey, you need to win the market. And people are like, well, what is winning? Interesting conversation. And then there are other discussions about growth. So the piece definitely hit some nerves, more than one, I'd say.
I think the thousands of people read this in the minutes that it goes out. And I was just talking to somebody yesterday, CJ, who writes this really nice newsletter, mostly metrics, and he loved it. And there was this huge cohort of people that had a lot of appreciation for what you were saying, and helping people see clearly what the state of the market really is today. Not making judgments, but just defining this is what the market is. And now you have to choose which game that is available you want to play and how you want to navigate it. The thing that you were saying, the debates that happened, I think all great editorials spark debates. The one on winning is super interesting. You know, all of them are interesting, but why, when you think of winning from an economical perspective or from a business lens, what is winning? Like, how should we think about that concept? Because people sometimes use different definitions for this, and they use like a life version of what that word could mean. In business, what does it mean, and why is it important to know what it means?
Yeah, and so that was one of the interesting debates because we actually. I mean, look, I'll summarize the article and answer the question. The article basically said, if you're an AI company in a red hot market, you need to go win it. And working 996 will be one of several extreme things you might have to do that. Frankly, I don't care how hard you work. I care if you win or not, because, we'll come back to it. The second prize really is a set of steak knives. I love the line. And it's absolutely true if you look at kind of valuation tail off of these companies. And then the other part of the argument is if you're not one of these companies, part one, you can't bluff it anymore. Because back in the day, I've been doing this for a while. Like when we moved to cloud, people could have no cloud revenue, but a really good cloud story and raise money and grow their business. And like, that doesn't work anymore. So the message was, if you think you can go bluff investors with an AI story without an AI product, which has a AI growth rate, you're wrong. You're going nowhere. It will not work. So the bluffing era is over. That was another key message. And then the last key message was, if you're in the not category, you got to figure out how to grow. But let's go back to your question, the winning question. The debate did fork off into, Dave, life's a marathon. I'm like, hey guys, I'm 63 years old. Like I've run 24 of the miles. Like I know it's a marathon. Like you don't have to lecture me on the race. So again, we had the whole life is a marathon thing come out of it, and like you can't sprint forever. And I stumbled into a really good analogy there because when you challenge me, I like to come back. I'm like, you know what? It's a marathon for the founder. But if you're an executive, like I spent at least 20 years of my career, you're in a relay race. Congratulations. And you're going to run a few laps. The founder is going to run the whole marathon. But, if you're lucky, like Business Objects, I was there for 9 of the 19 years we existed. I was still, I had a very long leg in the relay, but I was still in the relay, right? For the founder, it was a 20-year race.
You also spoke about the pace at which you run, right? Because I was thinking about this when, as this was unfolding. If you look at the person who wins a gold medal running a marathon, they run that marathon at a pace that is my fastest pace. And so we say marathon assuming you're slowly kind of making your way through things. And that's just, people run marathons at different paces.
I forgot that one. Thank you. That was the other thing I said. Because it's like, okay, you really want me to think about metaphors, which I like to do. And then I'm like, wait a minute, marathoners run really fast. And then I started to actually get the numbers. It's like they're running faster than 99.8% of the population. Like they're running 5-minute miles, sometimes sub 5-minute miles, right? Like most people listening to this can't keep up with the marathoner for a half a mile, maybe even a quarter mile, right? And they're going to run 26 of them. So if we have some notion that marathoners jog somehow, they got to pace themselves, in the metaphor, at least, it's wrong. Not if you want to be world class. We can talk about work in a minute, because I do think, look, my view in the work issue is it's okay to sprint sometimes. You can't sprint the whole race, whatever your pace is. And I get that, right? I've done the work-life balance thing. I've raised 4 kids. They still talk to me. We have good relationships. I'm still married, right? Like, hey, we're lecturing the wrong guy here on work-life balance, because I actually think I did a decent job at that. But so I think you're correct that first the marathon metaphor needed some kind of detangling of like, hey, wait a minute, it's not quite that simple, folks. And then what is winning? Look, my second favorite book on strategy, this guy, his author is Robert Bergelman, and he basically defines strategy as the plan to win, which instantly begets the question, what is winning? So it's my second favorite book. My first favorite book is Good Strategy, Bad Strategy by Richard Rummelt, which I think is better. But this notion of strategy is the plan to win, and therefore you're immediately taken to the question, what is winning? I think is super, super important. So these people are literally screaming at me like, what is winning anyway? And it's like, yeah, if you're defining a business, winning could depend. Right. But I would argue by default, if you're a VC-backed company in a red hot market, winning means being the market share leader. When I grew up, about being Oracle, not Ingress and Formex or Sybase, most of whom none of you have ever heard of, right? Because they were the runner-ups against Oracle in a relational database market. Right. Back later, when I was at Business Objects, it meant being Business Objects, maybe Cognos, not Brio, or MicroStrategy reincarnated, but they were a BI vendor. They reincarnated as a Bitcoin play. But it basically means market share. So when I speak of winning, the short answer to your question, Assad, is winning is market share. I'm not talking about selling your company for a high valuation and running away. I mean, yeah, you can make a lot. That's called making money, right? But in business, winning to me is building an enduring company and winning a market.
Dave, do you think that there's ever I hear you on the marathon metaphor, having run, I have run 5 marathons, and I will say that the point of the metaphor isn't whether or not you're the same speed as a Kenyan. It's more that when I've run a good race, it was pacing myself. And when I ran a bad race, it was coming out too fast and too hot and then losing my legs, when you hit the wall in mile 20. And so but this is actually a strategy question, not like a metaphor, question. It's in your experience, given your decades in the Valley, like is there there's one world, but maybe this is a false choice. So I would love to hear if it is. There's one world where you push really hard to get market share, but maybe you're cutting corners in product development, or you're cutting corners some other way, or you're just pushing so hard, but the business isn't mature or sustainable enough to support whatever happens when you get there. And I think one question I have, but I want to hear, because I'm happy to, I don't really have an opinion, actually. It's just a question. There's one part of me that feels like these AI growth rates, Alison and I talk about this a lot, are, I don't know if they're artificial. I don't know how sustainable they are. Not just from a not even from a 996 perspective, but more from, is this revenue dependable and reliable? Is this market share that is permanent market share, or semi-permanent? I guess no market share is permanent.
Yeah.
Or is it like, listen, to your point, you still need to like win the market, and we can agree that that's the definition of winning. But is there a different way to run this particular race that will enable you to sustain it longer, that will get more durable market share? Or, to your point, because maybe this is true. Maybe it's like, listen, once Oracle got what they needed, everybody else lost. Once Google got what they needed, everybody else lost in terms of market share of search. So maybe it's like, listen, market share is so valuable. We need to get there as quickly as we can. We need to become as entrenched as we can, even if some of the products we're shipping aren't first rate, or even if AI itself isn't quite ready for prime time in the way that we're being told it is, because we need to get there first so that we can maintain our position as the technology catches up with the promise of it.
Yeah, totally understand. And there's a couple of cases embedded in there. Let me walk through them. One, just a brief reminder, my point of view is enterprise software and the systems level stuff, right? I grew up in the database market. I was an operating system guy in college. That was my favorite thing to work on. So I do kind of look bottom up from the stack. And I think there's two kind of economics type principles that matter, that underlie a lot of the stuff I say. One, basically, if you have high switching costs in your market and strong increasing returns to market leadership, then my default viewpoint is correct, right? And what does that mean? It means high switching costs means, yes, you can get in with a second-rate product because you won, and you may have a lot of customers who don't like you very much, but they're going to stick with you because it's too hard to leave, right? But Oracle didn't win a whole bunch of customer success medals in the 1970s, in the 1980s and 90s, right? But they won the market share, and they were not beloved. I don't know if they ever were beloved, but the point is,
Salesforce is doing exactly that to my company right now. So a very good point.
Yeah, so it's all about, so a lot of what I say on strategies is it's based on some underlying assumptions that may or may not be true. And I also tried to emphasize some of that in the debate. Maybe I could have said it clearer in the article. But my default frame is, you're in a greenfield market, right? So there's a field full of corn that we need to go pick. And the metaphor is going to break down very quickly, because basically there's two things happen. One, the more corn you pick, the more you can pick, so increasing returns, and then the harder it is for somebody to switch if they had somebody else pick their corn. Forget the corn metaphor, it's terrible. The switching cost metaphor is good. Well, the corn metaphor works for the greenfield, right? It's a race to pick the most corn. It doesn't work for either the concept of switching costs, which I think are pretty clear. How hard, how hard is it to move from Excel to Google Sheets? It's kind of hard. It's a little hard. How hard is it to tear out your ERP system? It's really hard.
Very hard.
Right? Zach Nelson always used to call it a heart transplant. Right? He called it
5 years to implement that thing. Tearing it out is not something people.
Yeah, seriously, right? So that's switching costs. Like, there are people who just like, switch my ERP. Are you insane? And like, whether or not they're happy with the vendor isn't even the question, right? It's just too difficult to contemplate. So if you're in a market that has high switching costs and you can benefit from that as the vendor, then yes, you want to go grab as much market share as you can, even if you're not going to win any medals for for your product or your customer satisfaction, because you could fix that later, right? Once you get the market share. The other thing I'd say is software often, and again, not always, has increasing returns of market leadership. This is a real story. Back a long time ago, one of the first sales calls I ever went on, and they said, Dave, because I was a technical guy at the time, they said, before you begin your presentation, you should know that unless you can convince us you're 30 or 40% better than Oracle, we're going to buy Oracle. So you may now begin. And that is a true story. And it changed my career because I was just like, holy cow, this is going to be really hard. We're probably not going to win. And wouldn't I love to work at a company where I was on the other side of this? Right, because it sucks. It sure sucks to be on this side of it, right? But you want to know how you can have a highly productive sales force if the buyers are in that mindset, right? That to me is increasing returns, and increasing returns in software happen for rational reasons, right?
Right.
They're not always technical reasons, but like committees buy software in the enterprise. Committees hate to make mistakes. Herd theory, right? Well, gosh. If we're going to pick this, if we pick a database system and we pick the wrong one, it's going to be really bad, but at least we picked the one that everybody else picked, right? So we all go down
got
together.
Fired for hiring McKinsey, right? Like no one got fired for using IBM. Like these
Bingo.
things, these cliches are there for a reason.
And the cliches exist because they're real. That relates to human behavior in committees. It relates to, it's basically rational. Some said there are some bigger ecosystem, more partners, more integrations, right? There's a whole bunch of really good reasons, some of which can be product related, but many of which are not, of why in various categories of enterprise software, the rich get richer. And I was, by default, my frame is you have increasing returns at work and you've got high switching costs. So yeah, you do anything you can to win right now because whoever wins this round is going to be in there for 10 years. Like it's over. Don't even bother anything. So that's where I was coming from.
In jiu-jitsu, when you train, you take various offensive and defensive positions. So one is you go on your back and somebody goes on top of you and then they start the round and you need to get out of that negative position and that person needs to dominate you. And it's much harder to get out when you're under than when you're the other person, when you're the one on top and you just have to maintain that position. So that's one thing. The other is that if you look at OpenAI, I think OpenAI is very indicative of a company that is benefiting from market share, even though in their world, switching costs are fairly limited. A lot of their revenue, the greater majority of their revenue comes from users paying $20 to $200 a month. And you can easily switch to Anthropic, you can switch to something else. And some people have 2-3 things, but most people have one main one. And there isn't as high switching costs there. But if you look at OpenAI, they have the greatest mindshare in this AI space. They have 700 million people using it. And that market share has become the leverage that Sam Altman has translated into all these things that we're reading in the news every single day. The deals that they're making with the chip providers, the deals that they're making with investors, all of these things that they're doing to further entrench themselves as the dominant player in AI are things that number 2, 3, and 4, even number 2 is having a difficult time doing the things that number 1 is doing. Anthropic is trying, from what I understand, talking to people inside and who know the space, Anthropic is trying a lot of the same things, but they're not having the same momentum there as OpenAI does. So I think once you dominate a market, it becomes a lot easier to maintain that position, even in things like consumer.
Yeah, it makes sense to me. Look, it's not clear to me that foundation models have high switching costs and increasing returns, or as much as, say, operating systems did or databases did, or any low-level platform infrastructure. Basically, the more your platform and people build stuff on you, the more you're slightly proprietary, because basically being proprietary is what helps keep switching costs high, and standard APIs help reduce switching costs, right? And I think that the issue with repeating too much tech history is that the market learns over time. Like, great example, that Oracle is here today because IBM invented the relational database and couldn't execute against it. So when 2 decades later, a bunch of researchers led by IBM invented xQuery, IBM killed it commercially. Right? They're like, hey, we're not going to do this again. Like we did this once before. We made a new database paradigm and a new query language that somebody else implemented before we did. We're not going to disrupt ourselves. So IBM basically, despite IBM and Oracle, who had huge contributors to creating xQuery, which was at one point a post-SQL query language, learned, right? And I think the world has learned here, maybe from the dominance of databases and operating systems, but open standard APIs seem much more important now like most of the vendors I work with are trying to be model agnostic, and it doesn't seem that hard by comparison to making your payroll application work on both Oracle and Sybase and DB2 or all three of, right? It
Do you
just
think
seems
that's
easier.
why OpenAI is so focused on the consumer side? Because there's an emotional connection with the consumer. Like if you look at usage of these AI models, so much of that usage is a very personal use case. They use it as a form of a therapist, a career coach, or this.
Aren't they focused on the consumer usage, Asad, because it's just a much, much, much bigger market if you win it? It's harder to win, but the biggest companies in the world are Facebook, Apple, Google, right? And I mean, I'm sure B2B contributes, but isn't the fact that there's 8 billion possible customers probably the big driver?
Like you guys do this enterprise commoditized nonsense. Like we'll see you there in a minute. The question
so I'm not sure. Short answer is I'm not sure. I think Sam has a good hypothesis. I would say that, but back to the notion of increasing returns, Facebook is a great example, right? The more people they get, the more people want to be on Facebook. I remember back in the early days of social media, I don't know if you remember this, but high schools would either go MySpace or Facebook, but the whole high school at a time. That was increasing returns at work, because if all your friends are on MySpace, you want to be on MySpace. It doesn't matter what the school across the street is. It matters what your school is, right?
Does this also speak to why there is so much excitement or exuberance from the investor side? Because once you become a dominant player, once you own the CRM space or the ERP space, it almost takes a platform shift for a whole new dynamic to present itself for somebody to be able to challenge your market dominance. Because it was almost impossible to fathom in the SaaS era that somebody will be able to do something to Salesforce. Like it was a crazy thought. Now it's like still hard to imagine, but the probability is much higher now with this new dimension than it was ever before. Is that why investors get a lot more excited to fund these plays, because there's finally a chance to challenge number one?
So yes. So I think disruption in general resets the order, right? The market order. So it's a chance to go, if you just read the market as the cycle that is these massive disruptions every 20 or 30 years, the conventional wisdom, I don't know if it'll be true this time, but the wisdom, this is what they all believe. It doesn't actually matter if it's true. What they all believe is that these discontinuities create the opportunity to reset the order, right? To take IBM, who was the champion of computing before client server, and just dethrone them, right? Or in this case, dethrone Salesforce or dethrone Oracle, right? Dethrone whoever you want to dethrone. And create kind of companies who will lead for 20 or 30 years. So that's why they're willing to do this, because it's super high stakes poker. I think in the markets I've known, there are also very clear increasing returns and high switching costs. I don't understand AI application architecture quite well enough to know how strong they are. I'm going to assume they're pretty strong because a lot of smart people seem to think they are. So I'm just going to kind of concede that. I couldn't prove it to you. I could prove it to you with databases or CRM platforms. But the other thing about this one that's unique is it is a bit of a spending contest. I mean, I've always said SaaS was a spending contest. Like, hey, if we're going to buy customers for anything more than $1, it's a spending contest. You got your product, I got my product. Hey, we're each spending $1.50 to get a customer who's $1 a year. Then who's got the most money, right? Who's going to? So all of a sudden, the difference between the first round of Silicon Valley startups I lived in, the VCs used to give everyone roughly the same amount of money, like $20 million roughly, and say, hey, have at it, let the best company win. Like they weren't trying to pick winners, at least in the 80s and 90s. And then somebody figured out, hey, wait a minute, if we give us, we could actually affect the outcome by giving you more money than you. And then SaaS made that even clearer, because it's like, well, you got a CAC ratio, it's bigger than 1.0. You must definitionally burn cash to grow the company. So who's got the most cash? And then how high are the sticking costs? What's LTV to CAC?
Give the most cash to? Like if you have 5 people in front of you and you're like, I want to give the most cash to somebody. I think capital makes a difference. So I need to pick out of 5.
Yeah.
Whoever has the most market share would be the one you would love to give it to, because that person already has an advantage. They're like running a little bit ahead of everyone. So it's like, okay, if I give it to you, I'm most likely in this high risk play that I'm doing, I'm a little bit de-risked compared to if I give it to number 4 and they need to go past 3, 2, and then challenge you at 1. Yeah. And so there is a gravitation of resources towards number 1. That's why market share becomes really
increasing
important.
returns of market leadership. Yeah. Like literally, I use the phrase ceteris paribus a lot. So all other things being equal, ceteris paribus, I'm going to invest in number one every time. But why would I think the guy who's currently in fifth place is going to get first? And that might be first place is a $10 million company, second place is a $5 million, and third is the $3 million. They're not that far apart. There's only $7 million separating them. But first, we'll get the advantage there. And this is back to increasing returns of market leadership. The rich get richer in enterprise software, which is why I have a blog post called The Market Leader Play, which documents, like, and step one is get into first right now. And step two is like, hold it. And in the SaaS era, it was get a great team that VCs would like, and they'd, and get good investors on your cap table who other VCs like, probably even more important, right? And then have a reasonable CAC ratio, and people are going to give you a ton of money to go buy customers. And if your software is sticky or high switching costs, sticky is kind of the colloquial term for that, then you can build a great company. In AI, I think it'll be similar. I'm not sure it's going to be identical, but there's one other element of the spending contest in AI, which is all the compute it takes. Right, the amount of compute, the foundation model businesses, these numbers are mind-boggling.
Do you think that there's an inverse relationship between, to your point, switching costs are the thing that I think, to your point, like increasing returns to market leadership and then high switching costs? The rate of growth of some of these AI companies, to me, would run counter to the concept of high switching costs. Like if it's so easy for them to grab this revenue so quickly, then I would presume that the companies they're selling to are not necessarily switching from anything, but have some pot of money that is, for AI projects, and they're investing into these high growth companies. Or am I misreading that, do you think?
So look, I mean, it relates to one of my other principles, which is consumers are fickle. Of my 4 kids, I told everyone to go into B2B. One went into B2C. But literally, consumers are fickle. You're rich overnight because everybody loves you, and then you're MySpace 2 years later, and you don't even know what happened, and you're dead, right? And you're still trying to figure out what happened, and it's over. So B2B happily is a much more rational world by comparison. Like, at least we explain why the mechanics are happening. So I do worry about the easy come, easy go aspect of the growth of some of these people, which is, if you're taking a guy who did a trial, or a person who did a trial and paid you to call it $50 a month and calling that 600 bucks in ARR, is that valid? What's the duration of that contract? Was the consideration of the purchase high enough to call it ARR? Basically, the big question I say, Sam, is basically, is it just revenue or is it ARR? Right? Because there is a difference. And a lot of these companies, I'm not at all convinced it's ARR. It's just people trying it. It's the hottest thing that everybody wants to try. They want to try multiple models, right? I want to try Claude, and I want to try ChatGPT and see which one I like better, right? So eventually I'll settle on one. But so the market looks 2 or 3 times bigger in some sense because everyone's trying everything before they settle. So yeah, I think it's a big issue for the VCs, and they're good at what they do, and this is the scale of this spending is unbelievable. It's $30 billion. I mean, if you told me a VC-backed company could compete against Facebook, who is either $30 or $40 billion in free cash flow, and they're investing all of it and more in this race, and you're going to go fight that with Google, who is similar, tens of billions in free cash flow, and you're going to fight that with venture capital, I would have been like, you're crazy. You can't do it. And they're doing it.
I would read up on this. If you look at the space, the mission to the moon, inflation adjusted, it was a $3 billion spend in entirety. Brought us to the moon. Yeah. They're spending that every 10 months right now in this data center build out. It is crazy to spend.
Do we think, Dave, to the point of it, I just have a question about like motivation, because some part of like the 996, marathon versus sprint, some part of that is, I think you correctly point out, like, and you can disagree with me, like it could be emotional, right? People feeling like, stop telling me I got to work harder. I'm working as hard as I can already. It's enough of that. There's another part, which is, to your point, like the rational motivation to get as much market share because there are compounding returns and increasing returns to market leadership. But there's this game theory part of it, and I don't know if it's the prisoner's dilemma is a good example, but maybe it is. Everybody confess, right? Which is everybody pushing their RPMs to 10,000 RPMs, everybody redlining their motors as much as they can, nobody feeling like I can actually take the time to build a sustainable business because the risk of me not getting that market share is too high. Therefore, I need to run as hard as I can, as fast as I can. And to your point, if we're buying revenue, Who cares if I have negative gross margins or 20% gross margins? Who cares if it doesn't look at all like a cloud-based SaaS business? I need to get that market share as much as I can. Therefore, you have this collective group of people that are all building effectively bad businesses because one of them will win and most of them will lose. And so all of these entrepreneurs are pushing themselves to the absolute max and in a way destroying shareholder value over like the medium term potentially, right?
Yeah.
But it's a rational thing to do because the price or the bounty, like the gains of winning, the riches from winning are so high that it's really like the only thing that you can do.
Yeah, I mean, roughly, yes. I mean, that's what, if you want to know what's going on, that's what's going on. It happened during the internet bubble, right? It's not the first time we've seen this. And well, I think it's from the article, but always remember that from the wreckage of Webband and Pets.com and 100 other .coms sprung Amazon, eBay, Google, right? That's exactly what we're living right now. And I think we're old enough to remember how crazy it was and how wasteful it seems, right? Because it's a little bit like, I'm going to take a terrible example. Let's see if I can get a better example. So sometimes Mother Nature just throws numbers at things. Like, I'm a fisherman, and if you want salmon to reproduce, you send all the salmon up the river and they all lay like thousands of eggs. So you're just throwing numbers at it. They're getting eaten by bears, right? They're getting caught by people. Like, there's all kinds of bad things happening to salmon as they go up the river, but you just throw so much numbers at it that the system works, right? It's kind of what we do in Silicon Valley is we just throw so many dollars and so many companies at it. Yeah, a lot of companies get eaten by a bear, stepped on, crushed, on the way there, but there are some winners that emerge. So I think the quote I have was, nobody said creative destruction came without casualties, right? Like, this is creative destruction at work.
Destruction is the key word in that phrase.
Yeah. It looks incredibly inefficient and insane when you're watching it, right? Like, I personally have very mixed views on the whole Silicon Valley system, but this is how I live with myself as part of it. Like, it looks crazy, but there's nothing like it to produce these companies. So I wish we could do it. I wish we could do it better, but we don't know how. Yeah, go ahead.
It feels like, going back to the winning discussion, winning's definition can be slightly different based on the type of company. Because if you're doing venture, if you have decided you need starting capital, you need risk capital, venture is where you go. You're selling them this dream of creating a venture scale business, and they're going to fund it to see if you can do that. And so winning in that context is winning your market. If you talk to PE, winning is being able to sell this thing for 3 to 5 times what we bought it for in 5-ish years from when we bought it. If you speak to somebody who's a bootstrapped founder, winning is $2 million in distribution every year, and I sign off at 4 p.m. It could be because they get to define what winning is because it's their business and it's a certain scale that they're at. So you can define winning to some extent based on this type of business that you're running. And I think what gets really confusing is when people that are either used to a specific game, they're looking at the world coming from private equity and they're looking at venture and they're making judgments on it, or they're coming from a bootstrap background and making judgments on it. I think there's a lot of confusion that can happen there, and there's a lot of sentiment that you feel in the market from those people. I think, having run a search firm for quite some time, I don't think that the employees that join these businesses are confused about the game that they are playing all that much, or at least the really good ones. The really good ones know that if I'm joining one of these fast-growing AI companies, what I'm signing up for. And they're signing up for it for a reason, because they believe that the probability for faster than average upward mobility, for outsized earnings, is higher there for them than somewhere else. And so they're making informed decisions about which game that they want to play. And they're not being that judgmental about it either. And so it's interesting. I don't find that there's a lot of confusion amongst the people that are actually playing the game.
Interesting. So look, there's 2 dimensions you said there, and I think you're correct. I just want to build on your point, which is the game you're playing is going to be, in my mind, a function of 2 things. One, who owns you, right? So the owners and their interests, and you said it very clearly, VCs moonshots, PEs base hits, and then bootstraps just want good cash flow and
Whatever
eventual
you want.
exit. Yeah, whatever you want. The other factor, of course, is the market. Does the market have high switching costs and increasing returns that we talked about? And, just a reminder, some of these things didn't, like travel websites. I use all of them. I switch back and forth, right? There's no switching. So I think sometimes people get confused because if you act like every market is a greenfield platform market with a high switching costs, right? I remember when I was in business school, we did a simple example where it was a wine example. It was like, hey, it was alcohol, it was vodka. It was like, hey, you've got a brand at this level, cost $10 a bottle back then. If you introduce one in 8 and one in 12, what happens? And I'm like, well, 8's going to get more market share. They're going to get more land grab, blah, blah, blah. And then like, well, what happens if you increase the price back up to 10? It's like, oh shit, you don't have any advantage and there is no increasing returns and there is no switching costs, right? I can make a Bloody Mary with any vodka. So I think it's when people get confused, to your point, a little bit of you've come from one world and now you're in a different world. And wait a minute, vodka doesn't have switching costs and they buy a bottle, once a month or whatever. Whereas the software, you buy it once a decade and it has massive switching costs. So those are the two things that drive it. And I think I think employees, what do I think? That's very hard to generalize. I'll say this. I think employees get into trouble when they mismatch something. Like, for example, one of my beliefs is if you think your company is losing and you're in one of these big markets, don't 996, right? Because you're throwing it all away for nothing, right? But if your company is winning, right? If your company's crushing it and going to be a leader, if they're asking you to 996 it because you want that brand on your resume, you want the value in the stock options, right? So to me, it's just all about matching, right? If you want to,
Dave, to that point,
yeah.
That's a really interesting thing that you said. What are your thoughts on a company that's number 2, that's trying to become number 1? So they're not losing the game completely. They're in the fight. They're in the fight still. They are number 1, but they're in the fight.
Anthropic, baby.
Anthropic can say, listen, we're going to work our butts off to try and get to number 1. And the leaders are doing it and they want the employees to do it. And they're communicating up front with the employees when they're bringing them into the organization. This is our work ethic. This is what we expect of you. At that point, would you say to the employee that they should do it? Or is it just, unless you're at the number 1, you shouldn't do that?
So my belief, first, there's just as a former CEO, right? You guys know I've been a CMO several times and a CEO several times. It's a horrible message to employees, like, hey, everybody go work harder. It just doesn't work. So in general, never say that. Now the reality is, if you're at Ramp, you should want to work hard because you're at an amazing company, and that's going to help you. It's going to help your networking. It's going to help your brand value on your resume because Lord knows recruiters are brand shoppers. Right. So you should have a lot of incentives to want to succeed. If you're working at a company that's not succeeding, look, I don't think work ever offsets strategy. Like what's going to make you win is not, hey, everybody pull harder on your oar. It's we need a good strategy to win, which is usually either some sort of try to overtake number 1, which is very difficult, or typically segmentation. Right? Like, I'll give you an example from databases where I grew up. Oracle won the mainstream database market. It was kind of over. A lot of people tried to attack them. The only successful attack was data warehouses. Because, it's a database not for banging transactions, but a database for analytical. So Redbrick, Teradata, right? They didn't make it. Eventually, they got smothered, but it was a valid strategy to say, we're number 2 in relational. Should we keep fighting direct attack on Oracle saying we've got a better product, or should we segment? Right? Should we do something else? Should we find a use case? And you could argue Snowflake, the cloud data warehouses, gosh, they did incredibly well through segmentation. It was not a broad-based attack. So I think the answer is, for a person, you just got to decide whether. I'll give you one other story though. When I left Ingress, which was the first company I worked at, it was one of the losers in the relational database market. I was there 7 years. Most of my job interviews were, you seem like a smart person. You seem reasonable.
Why were you there for 7 years?
Tell me again why you were there for 7 years. And the question would happen like 3 times per interview. And I was like, okay, can't do this again, right? Like, I need to be spending time at places where people are like, oh, that's great. You're at Salesforce, or you're at Business Objects, right? Yeah. So that's what I'd be thinking if I worked at a number 2, because sometimes number 2s do okay, right? And they have a good brand name and a good reputation. Sometimes they don't. I don't know. HubSpot's a great company. They're not as big as Salesforce, I don't think, right? But it doesn't do any harm to work at HubSpot. You could argue they're segmented, right? They picked the bottom end of the market, left Salesforce at the top end. So yeah.
HubSpot does less revenue globally than Salesforce in Germany.
I think, Asid, one of the things this debate sparked, and I think both of you had some great comments, and Asid, I love your take on this, which is that there seems to be, you can call it resentment, you can call it frustration, and I don't know if it's demographic, I don't know if it's like older people versus younger people but there's frustration that the power dynamic has shifted from what you might consider labor to management. And I think that's part of what we saw, and I think, Chris Walker or other business people that have achieved some kind of outcome that are saying like, that's not what, winning isn't winning market share or making money. Winning is, achieving transcendence and, living on the astral plane. And, also, we were talking about this before we started recording, but I wonder if you feel like there's been a shift in a power dynamic, and particularly because if we think about some of the employment trends right now, we've got return to work, 996. Who is that going to trigger? That's going to trigger somebody with children, somebody that is maybe tending to older parents, somebody that just doesn't feel like I don't have the time.
I'm busy a lot of people from the generation that for a while were saying the young ones don't work hard enough.
Well, I think that's part of like, we're sort of alluding to it, but I feel like we're not quite, because the other thing which Dave and both of you have pointed out is a lot of those people are, there's an upper elite group of operators that are all, they're going to work at OpenAI, they're going to work at Lovable, but then there's this huge class of C-suite executives and SVPs and EVPs at growth stage SaaS businesses that are pretty stuck when it comes to their ability to grow. And so they're sort of feeling like they're being told, you got to do more, you got to work harder. And they're like, I don't have anything more to give. And I'm not even, I just feel like that's part of what like, you want to call it uproar, but part of like the anger was not really anger at the article necessarily, but anger that the circumstances have changed in ways that feel out of their control. I don't know if you agree with that or disagree with that.
I think about labor leverage a lot, obviously coming from the search firm space. And I think it has everything to do with demand and supply of talent. And I don't think about it in the context of the demand for top talent, because I think hiring the 1% is difficult irrespective of the state of the market. It's a little bit easier when the market's crashing, but it's still kind of hard to hire 1%er. But how hard is it to hire the average employee is very indicative of where leverage sits. So if you think back to peak Zerb, what we were noticing was it was kind of hard to even hire an average B player. Like, it was pretty hard. And so when it's hard to hire a B player, it means that labor as a group has a lot of leverage because the demand for them has outweighed supply to a level where now their needs and wants are being catered to try and attract them and retain them. And I can share a lot of anecdotes of how that materializes in terms of retention packages, comp packages to pull people over, etc. But a lot of crazy things were happening then. And when you're trying to win them and keep them, you start thinking about their needs and their wants, and you start really emphasizing aggressively on their wants. And so what are the wants of labor? Labor would like to earn a lot of money with less pressure. It's one of them. I'd like to have a half-day Friday or a 4-day work week, or I would like the flexibility to work from home. A lot of the surveys were showing this, like flexibility was a top concern of labor at the time. They wanted a lot of perks that were related to mental health, fitness, all these things. And so you would see these organizations that were hearing, okay, what is it going to take to get you guys over and to keep you? Okay, fine. The surveys are telling us this. And you would see it materialize in job postings, job offers, career pages, etc. When the economy becomes challenged, so interest rates went up, the cost of capital went up, and the economy started becoming a lot more challenged, at that point, demand dropped. And so when demand drops and layoffs happen, now supply is up. And so labor loses its leverage. And they lost that leverage in about 2023. 2022, 2023, 2024, they still didn't have it back. Now what's really interesting is the market is, from some angles, pretty hot. I was telling you, Sam, right before coming on the pod, I was reading CNBC. Beyond Meat is up 120% yesterday and 120% today because they got added to the meme stock ETF. And so there's madness happening. It's a hot market on the stock market, but it's actually not. The demand for the average person isn't very high right now. There might be a few reasons for it. There might be certain reasons where companies, I think, are realizing the importance of hiring great people in navigating these difficult markets. Maybe AI is making it so that you need less of those people in some functions. But for some reason, the hotness of the stock market and the valuations and the fundraising and all of that hasn't materialized into higher demand for the average person or something close to what it was in 22. And so labor doesn't have its leverage right now, and companies have still maintained it. And so they're using it. They're saying, we want you to come back into the office. We want you to work a certain way. There is no half-day Friday. We're walking it back. They're doing all these things. And so people are frustrated. And people are very frustrated at that. And they can't do anything about it right now because you need a job beyond all those. Those things come secondary to wanting a job. And so right now they just are in a stuck position. So there's a lot of frustration. So when they hear it again, they react to that. And then I think some people take advantage of that. They, want to sell something in relation to this, so they'll take advantage of that type of sentiment. That's always how markets work. But I think the majority of it is just frustration of labor. That's my take.
So I think there's three things. I largely agree with you that labor employees have lost a lot of leverage over the last several years. I mean, remember during COVID, it was like, I wonder if we'll ever go back to the office. People would say that. And I'm like, of course you can go back to the office as soon as your boss has some leverage on you. But there's going to be some sort of return to office, right? To me, that was always clear. So I think people are smarting from the loss of leverage and seeing that visibly in their lives. I think in general, people don't like to be told by kind of rich people like VCs and CEOs, like, go work harder. So it's never a good message. Just note to self. So it automatically bothers people. And the only dimension you've not touched on is the US versus Europe one, because I do think 996 itself has generated a lot of controversy, I think, in Europe, because, as you know, I work with a European VC firm. I spent a lot of time over there. And you've got Harry Stebbings, who's a pretty lone voice.
Very lone voice.
Going, maybe we should 996 it too. And he doesn't get a very good reception when he says that, right? So I think it's seen over there as kind of a crazy American thing. And Americans don't know how to work-life balance. Americans only know how to work. And so I think there's that angle as well. I don't know how much of that was present in the reaction to our article, but I know that's out there in the world.
I also think that there is this argument that some will make that working this hard is not a necessity for success. And I think that's debatable. It is debatable because I think if you look back to some of the formative moments in some of the most important companies in the world, those are very hardworking cultures. I also think when there's geopolitics at play, or when there's geographies fighting for dominance in certain places, if one is doing something, if they're working 6-7 days a week, 12 hours a day, trying to solve a particular problem, and we're trying to do it 4.5 days a week, they just have more at-bats at that problem. And so competition does sometimes drive things in a way that it's not as much in our control. If we're playing this game and we're trying to win, and in this case, winning also means securing the country to some extent, or securing these continents to some extent, you sometimes are just driven by the pressure point. And I think there are a lot of examples of people that are able to run at that pace for much longer than the ones who say it's not sustainable would tell you they can run at that pace. People can, my cousin is in PE. If you talk to these PE people, it was his second marriage in Italy. It was his second marriage. We were in Italy. We were having a conversation. I was
There's
like,
no
hey,
hidden message there. Keep going.
that's the average number of marriages in PE. The average marriages in PE is 2. And so I was asking him, what are you going to change about how you live your life? He's like, I'm starting to think that I'll take Sundays off. I never forgot that point. Like, he was 47 years old. He'd never taken a Sunday off. And he was able to sustain it till 47. Like, he was able to sustain it. So people can sustain intense work ethics for a very long time, I think.
Yeah, I think they can, for sure. And the question is why. And look, I'm going to try and flip this back to the practical. If you're a founder and you want your people to work hard, don't tell them the 996. Don't tell them to grind. Give them a sense of purpose and mission, and make them understand the stakes and lead by example. That's how you do it. But you definitively do not do it by saying, I want us to create a 996 grind culture. Like, it just won't work, right? And I agree with you. People will work hard. Usually if you go to people and ask why they worked hard, the answer will be that I was really caught up in the mission or really caught up in the job. Like, there was something like I wanted to. Basically, it wasn't because someone was screaming at me. It was because I wanted to.
Sam Altman talks about that a lot, how burnout isn't working too hard. Burnout is working too hard and not seeing results. Working too hard and seeing results is incredibly energizing for most people.
I think I hadn't worked as hard as I did in the last 2 months in the launch up to this thing. And I was probably physically as tired as I'd ever been at the time of the launch. But I was so happy at the end of the first week and the second week, and it did not feel like, it didn't even feel as tiring. Like, I felt like there was adrenaline in the blood. So I can see that argument. I have a question, Dave. So in this conversation, there was a conversation about, so there's the haves, these AI companies that are growing at staggering rates and all the dynamics related to that. But then there's all these other companies, the SaaS era companies that at one point were high flying and fast growing and fancy and were raising all the money at the best valuations, etc. But they've stalled for some reason, right? What's your take? What's your general macro take on that cohort of growth stage companies, maybe 100 to 300 million in ARR that are not growing very quickly, that don't have a lot of margin? What's the path forward for them? Is it they stay stuck? Is it that PE comes and buys them up and switches it up for them? Is it that they have to uncover an AI? What has to happen there?
Yeah, so that was a big part of the story as well, right? Because just to segue back to what we said earlier, in the old days, the answer was go bluff cloud and try and get yourself sold. And my hypothesis is you can't bluff AI, because the reason I said that is I watch founders trying to bluff AI, and they've got 5 or 10 beautiful slides in their deck, and I'm like, do you have a shipping product, and do you have incredibly fast growing revenue? And if the answer is no and no, the slides don't matter. And I feel for you, because they used to matter, right? You weren't wrong 10 years ago, but you're wrong now. So that was the first step, is kind of realize the situation you're in. The second step to me is just do some basic math. Like, if you're a low growth business in a category that's uninteresting, you're kind of going to get financially valued, right? And just to do an example, I can buy a kind of a junk bond that gets 6% return right now. So if I wanted to get $1 million a year in cash flow off a bond, I could spend $15 to do that, or just say 15 to 1, right? Because it's 6%, $15 gets me $1, 50 million gets me 1 million. So therefore, kind of reverse engineering that, if your company throws off $1 million a year in EBITDA, and you just purely financially value it, and you compare the rate of return to a junk bond, which probably isn't bad as a comparative metric, you're worth $15 million, right? You're worth 10 to 20 times cash flow. I just landed at 15 in that example, but I think that's a sobering wake-up call. So step one is like, you can't bluff AI. You should go build it, but you can't bluff it. Step two is, what is your business worth as a purely financial instrument? Because you've lost the tailwind, you've lost a lot of the luster, and people are going to look at it based on financial metrics. And when you do that, you're not worth 8 times, because people will go, oh, I would have been worth 10 times revenue, and now I'm worth 5. And the answer is no. You're worth nothing times revenue. You're worth 10 times EBITDA.
Gavin worth that's not
a glaring lack of understanding on why any company was ever worth a multiple of revenue. Like, people don't understand that that's not like really a thing across.
It's not
history.
the standard. That's not the norm.
Oh, our revenue multiples look like price to earnings ratios, right? In other sectors, like we go 10 to 1, 15 to 1. The mean PDE of the S&P 500 runs around 15, right? And we'll go 15 times revenue, so 15 times earnings, right? So,
And is that also, that's a SaaS era thing? Like from my study of the history, it feels like we really started using these revenue multiples at the point where we had the cloud, recurring revenue, switching costs, all of those things combined to say, okay, maybe we give these companies these sort of valuations.
I think it's a function of positive, it's 120, 130% net revenue retention. If you understand that every dollar you put in on day zero is worth $1.30 on day 365, and you can reliably predict that, then the growth of that business becomes somewhat exponential pretty quickly. And that's why you get a multiple revenue. But
technically it's infinitely valuable, right? If you're producing, if your NRR is always, if revenue always grows by 1.3 every year, the company is worth infinity. So the math kind of breaks down. So I get your point, and focusing on NRR and driving high NRR and forgetting that NRR was kind of a 1-year growth rate. Right, it was this year's renewals versus last year's renewals. Like people weren't doing 3-year NRRs or 5-year NRRs, right? They were doing that. So it just led us to a place where people threw around revenue multiples like earnings multiples. And my main point here in step 2 is just make sure you understand how someone's going to value your company, because you might be shocked when you do, right? And it may change your behavior once you get through the shock. So basically, the net of it is you need to figure out a way to grow, because and you need to grow at cash flow positive, right? You have to be financially independent, therefore cash flow positive, right? Because you're not going to raise money. Why? Because you can't raise money, so you need to be cash flow positive, so you don't need money. And then step 2, you need to figure out how to grow. And unfortunately, if the fastest you can figure out how to grow is like 10%, that business is growing 10% with 5% EBITDA is not worth very much, right? It's worth, call it, even at 20 times cash flows is worth $30 million, right? And if you're
you're lucky
thinking,
if you get 20 times, because the other thing, Dave, is like if it's not growing that much, that's probably a retention issue. That's one of the reasons it's not growing that much. So then the stability of that EBITDA is called into question. Then you're like, I can't really count on 1 million of EBITDA because it's going to be 800,000 of EBITDA next year.
Bingo. So exactly right. So that's the problem statement. Let's just put it like, okay, we don't want to be that. So what do we need to do? And the answer, this is supposed to be the pep talk part of the article. What was, you got to figure out how to grow, because I've just proved to you why, because your business is potentially worthless, right? If it's either worth a little. If you're a bootstrap founder, $30 million is a lot of money. If you own it all, that's fantastic. But if you raise $50 million in venture, your common stock is literally worth zero, right? Because you can't clear the preference stack. So your business might be worthless unless you figure out how to grow. And the reason I felt people needed a pep talk is they've been told to figure out how to grow like about 10 times over the last 5 years. And a lot of people have fatigue on that question. And my answer is, I know you do, and I feel bad, but you got to do it again. You got to charge the hill again.
I actually think tens of thousands of people got that message, because even within my organization, when after reading it, there was this renewed discussion around like how important it is to orient our brain power towards growth more than anything else. Because sometimes you get just in the thick of business, you get like spread in a few areas. It's like growth is far more valuable than anything else. And so it should have outsized attention and effort going towards it. And I think tens of thousands got that message. In this are a few other things that one can pull. One is, if you think of a company like Outreach, which would be one of these stock companies, couple of $100 million in revenue if they haven't churned a bunch of it. They're not growing quickly. They don't have a lot of cash flow. But at the same time, the technology that they have has become really easy to build. So would a potential acquirer, like private equity right now, is also looking at all these deals and saying, which one makes sense in the world of AI, where like building things is becoming easier and these new things are popping up? We don't want to buy a thing that tomorrow Bob just vibe codes and then it comes and takes my market away from me. Is that going to be a big factor? Like whatever is the core technology that you have, how commoditized has AI made it? Or how easy it is to rebuild it with AI?
Certainly, it's going to be a factor. I mean, that's going to be the objection, but one of the strategies I recommend is consolidation, and I can't remember to the extent to which Outreach has participated, but that general sales tech space is consolidating, right? And there's a reason, right? Gong, who bought Clary? There's Rusty here.
Clary merged.
Yeah. ZoomInfo bought, and then somebody else bought. Oh God, I'm rusty on this. There's a lot of consolidation in the space. I can't remember exactly who bought whom, but that's a valid response to this, to just try and get more customers, presumably more products in their hands, more switching costs, better enterprise understanding, better ecosystem, right? All these things make you more resilient. I mean, I have always personally felt, and we'll see if this remains true, that domain expertise is one of the hardest things to replace. Like if you're Viva, you got a company full of people who are experts in pharma CRM and pharma documents, you're going to be hard to displace because you understand your customers a lot. So
They're
to
worth,
me,
$30 billion, I think, to your point.
yeah, the people who are going to get smushed are the people who have very thin, very easily rebuilt, basically thin layer apps. I think they're in trouble. Like if all you do today is what Gong originally did, which is transcribe sales calls. I remember the first time I saw Gong, I thought it was magic. I was like, this is that technology commoditized faster
Oh my
than
God,
any.
it's amazing.
Yeah, literally. One day I think it's magic, and the next day it's a commodity. It's like, what the hell happened?
The number of different
genuinely
vendors that are waiting in a Zoom meeting when you're trying to log in and all of the bots show up and you're like, I didn't realize. And by the way, but on the other hand, this is the size of markets. Many of those companies are over 100 million. Otter, Firefly, all Fathom, like they're all very,
I
very
just kick
large
them out without asking anymore. Like if I'm on a call, I'm talking to one person, there's like 7 of these things. I just kick everything out. I'm like, we're going to have a conversation here.
So,
Dave,
yeah,
go ahead.
No, I was saying, to answer your question, I do think it matters. Like if you're going to want to sell that business one day, to Sam's point earlier, people are going to look at the numbers. Say you figured out how to grow at 20-25%, and now you're throwing off 20% EBITDA. That business is worth a lot more, but they're instantly going to go to how durable is that revenue? How durable is that EBITDA? And your story about what's your, to use the fashionable term, moat, which used to be called barriers to entry, what's your moat going to be against somebody coming along and vibe coding you away in a weekend? I do think a lot of the early returns on that, I can't remember who it was again, but some big company said they were going to vibe code their way.
Klarna said they would vibe
Klarna,
code
right.
their
And then they backpedaled in like months. Like, so I think it's a lot harder. I mean, look, I've been doing this long enough that SQL was supposed to put programmers out of business originally, and then 4GLs were going to put programmers out of business, and then low code, no code was going to put programmers and applications out of business, right? All these technologies have always said, we're going to put the applications out of business because you can just whip up your own. It's true to some extent. Certainly a lot of those companies have been successful and sell a lot of software, but they haven't really dinged SAP or Workday or Oracle or Salesforce, right? The core applications. So it takes a while to do that. So I think you're right, but I think you have time, and the higher you're in the stack, the higher value added and the more vertical, I think the harder you'll be to get to.
Interesting. Yeah. That's a great place to end. Dave, thank you so much for coming on the show today. And thanks for talking about this. And my apologies for mischaracterizing the column when I wrote about it on LinkedIn, but I thought it was a great conversation.
Well, thanks for having me. No need to apologize. I appreciate it anyway. But we did start one heck of a debate, which I was not expecting. We started like 5 of them. So thanks for having me. And I think we all learned something.
It was great having you. And we'll look forward to your next hot take that comes out in the top line newsletter. Thanks a lot. And
thank you.
Asif, your opinion, my friend.
Goodbye.
All right. Thanks, folks. Give us 5 stars wherever you get your podcasts. Smash the subscribe on YouTube, and we'll talk to you next week.